Good morning, everyone, and welcome. Thank you for being here this morning. My name is Jacob Mohs, and I'm a senior analyst with FR Risk Management. Today, we're here to discuss a very important and very timely topic. The topic is closed-end interval funds. This is the second in an ongoing series of FactRight webinars where our goal is to help distill complex alternative investments into the key points that you need to know to run your business. We're going to be doing these about every 2 to 3 weeks from here on out. Our goal is to help you manage risk and find opportunities in the alternative investment space. Before we dive in, a couple quick housekeeping notes. This presentation is being recorded. You can watch it again as many times as you want. You can share it with your colleagues. And also, if you're working at the home office, you can share with your financial advisors at your firm as well. Additionally, you can download a PDF version of the slides we're going to use today for future reference. Well, we're going to talk for about 30 minutes, and you should have a webinar dashboard in front of you where you can submit questions at any time. We'll address technical concerns as they come up as soon as possible, but we're going to hold off until the end for the full Q&A. If for some reason I don't get to your question on this call, I'll make sure to follow up with the person later. We're also going to be seeking your feedback at the end of the presentation. As you exit, a window should pop up with a couple survey questions. Please take the time to fill that out. We take constant improvement very seriously here at FactRight, and we want to make the next webinar even better than this one. So now, without further ado, let's get started. Interval funds, used correctly, can be one of the most important opportunities available to independent RIAs and broker-dealers. Now, an interval fund is a structure that can be used to implement a wide variety of investment strategies. The increasing popularity of this structure has caught the attention of Wall Street Journal, caught the attention of Barron's magazine. They both had quite a bit of coverage over the past couple of weeks. Additionally, pretty much every conference you go to has discussion of interval funds, how to use them, how to manage risk while offering them. So today we're going to provide an overview of this opportunity set. We're going to start by introducing and defining the interval fund structure. And what are we talking about when we talk about interval funds? And we're going to discuss how this type of fund fits in with other types of funds. We're also going to go into how the availability of this product has been expanding a lot for retail investors, when previously it was more of an institutional thing. Then we're going to discuss really in detail how your firm can use interval funds as part of a broader allocation and an investment strategy. This is going to include both the benefits and the limitations of the structure, when you can use them and when not to use them. And then we're going to discuss the due diligence and research techniques that we use to mitigate risk and also identify the best in-breed funds. And then we're going to dive into the process of getting information from public regulatory filings on interval funds as well. Finally, we're going to wrap up with a Q&A session. And feel free to submit your question via the webinar module in front of you right now, and or via email if you think of it afterwards. And we'll try to get your question today. And if we don't, I'll make sure to follow up with you personally afterwards. So what exactly is an interval fund? An interval fund is a type of continuously offered closed-end fund. Interval funds are also a registered investment company regulated under the 1940 Act. This is important because the 40 Act provides a lot of protections for investors. An interval fund also provides limited liquidity to investors by repurchasing shares at predetermined intervals. It's usually quarterly, and it's from that is what it gets the name interval fund. Typically, they purchase between 5 and 25% of shares, and when they do that, they're repurchasing at net asset value. Now, other types of funds, such as recent BDCs, they might repurchase shares, but they can suspend that repurchase plan anytime without shareholder input. In contrast, with interval funds, the exact repurchase plan is defined in the prospectus, and it can only be changed with a shareholder vote. And to put that in the jargon, it's a fundamental policy of the fund. And this, of course, is a defining feature of what makes an interval fund an interval fund. It's important to note that interval funds are a bit different from mutual funds, which are open-end funds that offer daily liquidity. Interval funds are essentially like a liquidity compromise between the two extremes of daily liquidity and long lockup. And we'll get into how that impacts strategy in a little bit. So interval funds are close relatives of other fund types that are common in the independent broker-dealer space. A defining feature is that of all these funds is that they're regulated under the 40 Act, i.e. they're 40 Act funds. And broadly speaking, there's two main types of 40 Act funds. There's the open-end funds that can be redeemed daily at net asset value. Basically, that's mutual funds. If a 40 Act fund that cannot be, or for 40 Act funds that are not able to be redeemed daily at net asset value, those are known as closed-end funds. With the traded ones, they can fluctuate based on net asset value, or based on like a percentage of the net asset value, the trading price, and then the non-traded ones, they have some type of repurchase plan. But the key thing is you don't have that daily liquidity. That's what makes them closed-end. Interval funds are simply one subtype of closed-end 40 Act funds. And the key feature, again, being that periodic liquidity offered at fixed intervals. A few other things to note about interval funds. The fund advisor must be, or the external manager, they must be registered with the SEC as an investment advisor. This again provides a bit of protection for investors, and it also helps from a due diligence standpoint, which is finding information about the group that's managing this fund. The 1099 tax reporting is pretty convenient, especially compared to a lot of other alts that may offer similar strategies. Subscription paperwork is quite a bit easier than a lot of products in this space. The catch, of course, that we're going to get into is that the buying is point and click, the selling may not be, and you have to that's kind of a risk management issue. But the logistics of bringing on interval funds are easier compared to a lot of other alternative structures. And in many cases, too, we're also finding that these newer funds, they're often having lower investment minimums than other alternatives. So an interval fund can be a way to help an investor ease into an alternative investment allocation. So brief overview of the interval fund universe. Beginning of 2016, there are around 28 active interval funds registered with the SEC. So far this year, we've seen 8 new funds go effective, and there are another 19 or so that are registered but not yet effective. So put this another way, the opportunity set's about to double. There's more funds that are getting started, or about as many funds that are getting started as there are active. Some fun cocktail party trivia. The interval fund rule that the SEC put out, which makes the structure possible, has actually been around since the 1990s, although it wasn't that widely used until a few years ago. Most of the older, longer-lasting interval funds have very large investment minimums, and they're really aimed at family offices and institutional investors. But the majority of the newer funds that have been coming out have smaller investment minimums, and they're clearly aimed at retail investors. This is a lot of data for one slide, but the key thing to note is that a lot of the funds you see in the middle and the bottom, I mean, those are raising capital pretty rapidly, and we expect them to report even larger asset bases in the coming quarters. We track incoming filings here, and on this list of this selected list, you're going to note a lot of familiar names. A lot of the BDC and REIT sponsors are in the process of registering interval funds to implement their strategies. And when we go into a little more due diligence, you can see how you can implement a real estate strategy, a leveraged loan strategy, and other strategies within this structure. A couple of sponsors have joked with me actually that every sponsor either has registered one or is working on registering one, which is a little bit of exaggeration, but we're seeing a lot more sponsors enter this space. For comparison purposes, here are some of the similarities and differences between interval funds and BDCs and REITs. Key thing to note is that an interval fund can be used to implement practically any strategy if you manage liquidity right. And we'll get into liquidity and suitability in a little bit as well. And that's kind of the dimension on which interval funds are a bit different than some of the fund types that you may be more used to. So let's discuss how you can use interval funds in your business. First off, who can invest in them? Sponsors generally don't impose investor suitability requirements in the fund documents. It's not in the prospectus. Looking at the REITs and the BDCs, there's usually a section of the prospectus outlining the exact suitability requirements. You don't see that with these closed-end interval funds. In addition to that, the minimum is often quite a bit lower than other alternatives. However, you still have a very, very important responsibility at the firm to make a logical and prudent suitability decision based on due diligence and research. There's a wide range of strategies and risk-reward trade-offs that can be put into an interval fund wrapper. Everything from the most plain vanilla strategy to something very exotic and higher risk. And need to, and through the due diligence process, you can make a suitability decision of your own, and to make sure that you get the right interval funds in the right portfolios. So as I mentioned, the liquidity of an interval fund is sort of a compromise between the long lockups of the traditional non-traded space and the daily liquidity of either mutual funds or traded funds. And that has important strategic implications because many assets that make good long-term investments take a long time to buy and sell. But there's also often a lot of demand for investors to be able to get out soon. But if they're restricted exclusively to daily liquidity, that limits what they can put in their portfolio. Interval funds are going to have a fundamental policy outlined in the initial fund document to repurchase between 5 and 25% of the shares at net asset value at each interval. And it's the standard tends to be, or at least what we've seen in most funds, is quarterly, but they can also do it semi-annually if they want, or they could do it annually. It just really depends on the sponsor's preference. So there is limited liquidity on a periodic basis, but selling the shares is a lot more complicated than buying them. And that's important to note, make sure that the end investor understands that when they get into it. It's not like mutual funds where it's just you get out anytime you want. So it's point and click to buy, not quite point and click to sell. Consequently, interval funds are not going to be suitable for an investor who requires full daily liquidity. This product type is for investors who understand the concept of an illiquidity premium, who understand that it could be a delay in getting out. In an extreme, fire in a crowded movie theater scenario, it could take several years, as much as 5 years, to fully liquidate it. Everyone was trying to use the liquidity feature every quarter. It would take a very long time. And in pretty much all cases, it's going to be prorated. So if you don't get out right away, you got to get in line again. Obviously, when the fund is doing well, those tender offers are going to be very much undersubscribed. So it's just that nuance of it is something that the investor needs to understand, and that impacts the suitability decision. Another key area to review and consider is leverage. The closed-end fund is regulated under the 40 Act, so they have strict regulatory limits on leverage. For each dollar in debt issued, they must have $3 in assets, or as sometimes call it, 33% leverage. And that's not that high. However, what you do need to note is that a lot of interval funds invest in other funds, so there could potentially be a lot of leverage underneath. And of course, the leverage of the underlying funds in the portfolio would be non-recourse to the actual interval fund, but it might make performance a bit more volatile than you'd expect from just looking at the leverage on the fund level. So this is a good question to bring up with sponsors. Usually they're going to be able to share some information on what leverage looks like on a look-through basis, and they'll often have some sort of policy for the leverage in the funds they invest in. And you can also get you can make an educated estimate too by looking at the fund types they invest in. For example, if they're investing in REITs and BDCs, they also have regulatory leverage limits. But just the key thing is that you want to look at leverage on a complete look-through basis and not just at the fund level. Share classes, everybody's favorite topic in the alt space these days. A lot of interval funds will have multiple share classes, different sales expenses, different incentives for the sales force, and of course, different return consequences for investors. Sponsor does need to file to get exemptive relief to issue multiple share classes, but it's generally pretty easy to get, sort of a rubber stamping, at least what we've seen. And under the 1940 Act, the fund cannot discriminate among the share classes when doing tender offers, so that's certainly favorable. But investors need to be aware that these different share classes might have a different net asset value and a different offering price. And of course, any ongoing fees that one share class has will ultimately impact returns. So as in any case, when you make the decision to offer certain share classes as a firm, and then on each sale, suitability needs to be considered carefully. So how can you ensure that you have just the best interval funds and that you are selling them to just the most suitable investors? Well, the key to that is due diligence and research. I've said this many times before, I'm going to say it again. An interval fund is a structure, not a strategy. The actual risk-reward can vary drastically between different funds depending on the strategy that they're implementing within that wrapper. There's interval funds that invest in real estate. There's interval funds that invest in debt. There's interval funds that do venture capital, insurance-linked securities, hedge fund type strategies. It runs a full gamut. And that's something that needs to be analyzed, not on a fund-by-fund basis. And the way to think about it is, if you want to make an allocation to real estate, an interval fund is one option in order to implement that goal. If you want to make an allocation to long-short strategies, an interval fund is a potential wrapper. You don't want to just be thinking, that this is a wrap. I'm going to use this wrapper and then think of strategy second. I mean, you have to make a careful analysis of the underlying strategy and the underlying assets. And one of the key ways to get good long-term returns for investors, of course, is to utilize that, or to capitalize on the illiquidity premium by investing in longer-term illiquid assets. But with the exit options in the interval fund, you have to consider how appropriate that is on a case-by-case basis. So there aren't actually statutory restrictions on how many illiquid assets that the fund can hold. A good strategy for the fund to follow is to maintain enough liquid assets and cash equivalents and an unused credit line so that they can meet redemption requests, sort of a liquidity sleeve around the main strategy. For example, there's some funds that are investing 85% of their assets in private real estate funds while keeping the rest in liquid income-earning traded investments that can be sold within 24 hours. Others might have 85% of their assets in directly originated loans and then 15% in traded BDCs so that they're always able to meet redemptions when they're needed. A good due diligence question to ask is, can the sponsor meet the redemptions without doing a fire sale of assets? There might be a trade-off between the ability to generate returns and liquidity. This is especially an important consideration if you see sponsors entering the interval fund space that have been successful with other structures of longer lockup. You want to ask how well the strategy will work within the structure, and if their previous returns were achieved investing 100% in their liquid assets, you have to make adjustments for when they can only invest, say, 85% in liquid assets. And in order to understand how the liquidity considerations, that requires ongoing monitoring on a quarterly and semi-annual basis. Another concern and due diligence question to look into is duplication of fees. This is something that always comes up when you have a fund of funds type structure. The sponsor of an interval fund is going to disclose an estimate of acquired fund expenses in prospectus, and they'll update that in a subsequent time period. Fortunately, the operating expenses for interval funds are typically lower than non-traded REITs and BDCs, but the potential duplication of fees can impact the overall structure, or the overall fee structure. Typically, the fund is investing in other funds that are net of upfront fees, and or investing in institutional funds that have lower fees, but those ongoing fees typically are not waived, and that's an important part of your analysis. Interval funds are living organisms with money coming in and coming out over time. Portfolios change from quarter to quarter, and an important aspect of due diligence is tracking portfolio changes over time. Key information can be pulled from regulatory filings and found in FactRight quarterly updates and in our Advisor Vantage Point reports. A few more things to look for, things that need to be brought together when you make your decision whether or not to enter into a selling agreement or maintain the selling agreement. The duplication of fees we discussed, the leverage that we discussed, the share class suitability decision, and just the general decision as to whether a particular fund is suitable for a particular client based on the strategy and the fee structure. In all cases, you want to document why a particular decision was made at the investment committee level. Interval funds are a type of closed-end fund, as we discussed, and they're required to make regular public filings. These public filings are a bit different than what some analysts may be used to for BDCs and REITs. So I'm going to give a quick overview of how to navigate these filings on the SEC website and a little hint of our secret sauce on how we pull information in order to advise our clients. This is going to be very much inside baseball, just this one section, but I'll keep it high level, and if anyone wants to discuss in detail these particularities, just feel free to reach out to me. The initial registration statement is going to be filed on Form N2. That's very similar to what you see with business development companies. This is different from REITs, which have their initial registration statement on Form S11. This registration statement will be amended several times, and eventually you get a final prospectus, and there'll also be a statement of additional information, usually for closed-end funds. Watch for prospectus updates over time. On an ongoing basis, interval funds file semi-annual reports with very detailed financial information. The document to look for is actually labeled Certified Shareholder Report. There'll be a separate electronic filing called the semi-annual report or annual report that really just indicates that the report was mailed to shareholders, but not providing the actual information. The semi-annual reports come out in the second and fourth quarters. For the first and third quarters, you get a portfolio snapshot on Form NQ without much detail, but it can track those changes on a quarterly by quarter basis and follow up with the sponsor to understand how their strategy is developing. The structure of public filings for closed-end funds, such as interval funds, is different from BDCs, REITs, and other public companies. Closed-end funds do not file Form 10Q. In Q1 and Q3, you're just dealing with a portfolio snapshot on Form NQ. And to get additional information, usually you have to follow up with the sponsor. However, as is the case with other public company filings, that portfolio snapshot is signed by management, very major legal penalties for misrepresentation on that. Similarly, closed-end funds do not file Form 10K annual reports. Instead, they file semi-annual and annual reports on Form NCSR. A key thing to note from due diligence standpoint is that, like other public 40 Act funds, interval funds do get an annual audit. And of course, the financial statements, again, signed by management, very serious penalties for misrepresentation. One last quick note, in the near future, there may be slight changes to filing requirements for closed-end funds, but the general logic of the due diligence we do and the benefits and the limitations of the structure, they're going to stay in place. Thank you, everyone, for your time today. For more information and to access reports, please visit FactRightReports.com. To discuss the full suite of services offered by FRS Management, reach out to Scott Smith, Gail Schneck, or myself. We'd love to discuss how we can help you with your alternative investment platform. And with that, I'll open up to see if there are any questions. One question came up on the on the issue of daily liquidity. Yes, that is correct. Closed-end funds do not. Well, on the issue of daily liquidity, so closed-end funds do not have daily redemptions at net asset value. That's a defining feature. For traded closed-end funds, they do have a form of daily liquidity, in that you can sell it on the stock exchange, but that may be less or more than net asset value. So I get, so for traded closed-end funds, yes, they do have the daily liquidity, but it's just maybe at more or less than net asset value. The defining feature, in contrast to the open-end funds, is that their daily liquidity is at NAV, at net asset value. Thank you for that question. And there's one more on the issue of share classes. Why do different share classes have different NAVs, or different net asset value? And ultimately, they represent claims on different cash flows, so are slightly different cash flows, because if one share class has an ongoing fee, has some sort of ongoing fee obligation, that effectively reduces the net asset value available to that share. And so that's the difference. It's usually going to be like a penny or two, but it's just something to keep in mind. And of course, the offering price will be different, both because of that and also because of different sales loads. Have we ever seen an interval fund that made quarterly tender offers for more than 5% of outstanding securities. The ones I've seen, they always keep it very open. They'll usually say just between 5 and 25%. Have seen interval funds that will, if there's a demand for more than 5%, they'll and they can meet it, they will meet it. But usually, it's not as a matter of policy. Like they're not. I haven't seen interval funds that have a policy to buy more than 5% per quarter. I ask a very important question here. Can we get a copy of this presentation? Absolutely. You should, on your little webinar module, you should see under handouts a PDF file of this presentation. If for some reason the download doesn't work, just let me know and I'll make sure that you get a copy. One question here, aside from redemptions, do interval funds offer distributions? Usually, yes. It depends on the strategy. So if they're doing an income-focused strategy, they're most definitely going to be paying regular distributions when things go right. And that's a very, very common use. So the majority of the newer funds do have an income-focused strategy where they're paying regular distributions. There's a couple out there that have a capital gains focused strategy and they don't pay regular distributions as much, although they'll do like the capital gains distributions at the end of the year. But it just varies. Whether they do distributions kind of varies a lot by strategy to fund. But for the funds that are really focusing on the independent broker-dealer space, we expect regular distributions as a matter of policy. See, one question on BDCs taken public. A couple comments on this. I mean, with BDCs and REITs, going full cycle often means going public. With interval funds, they can theoretically go perpetually, where they'll just use the redemption fee. People can use the redemption feature to get out. There actually has been quite a few interval funds, like over the past decade, that turned into open-end funds, like they converted to mutual funds to allow everyone to get out at net asset value. And that's one possible exit, although none of the funds that we reviewed have that as a part of the plan, but it's something that's an option that's available to them. I believe we have gotten to all the questions and reached the end of our time. If anybody thinks of other questions, or I just failed to get to yours, please let me know, and we're happy to help where we can. Thank you again, everybody, for attending, and just a quick reminder, we have another webinar coming up in 2 weeks on ongoing due diligence. I hope to see you there. Thank you.